So proud of you. You are here on time. Can you give yourselves a round of applause? Yes, this is good. All right, okay, we've got an action-packed day 2, but just as a revisit on day 1, you're almost welcome. Of course, day 2 is a little bit shorter than day 1, but we had a wonderful, wonderful day 1. We took the time to have a 10-year outlook of what we thought is going to happen in our industry, both locally and abroad. We had the opportunity to talk on climate change. Chairman Elias Masilela did a very good job at getting us all to stand up as asset managers, asset owners, and give our own views of what our plans are as so far as climate change is concerned. We then had a very robust discussion in an all-lady team that was missing a few men, hey guys, on the gender lens of investing. In fact, on that note, I must share with you news that broke while that panel was on. I just happened to bump into Sam Pokroy, who is from Sanari Capital. Sanari Partners raised 1.2 billion rands, the equivalent of 65 million US dollars, in a second close of their growth fund with the PIC and, of course, Alexander Forbes' new investors. So this is a women-run, black woman-run private equity and venture capital firm. A round of applause to them. Well done, Sam. There she is. Well done, my sister. And I thought it was poignant that it happened while the panel was on, so I think that's pretty cool. And of course, PIC, you know, they manage the GEPF's money, so thank you, Mr. Principal Executive Officer, Mr. Mapesa, for putting where your money, the money where your mouth is. Day 2 continues. We've got a couple of panels to get through, and then of course we're going to wrap up just before lunch. We're going to be talking about sleepless nights. I thought that was an interesting way of opening the day. Sleepless nights. So these sleepless nights are the sleepless nights of senior executives of major pension funds. We're going to get going in a moment with Razia leading that. Then we're going to talk about infrastructure investing, an always tricky one for big or small pension funds. Then, of course, we can't have a conference without talking about the interesting world of regulation. So we're going to look at the world of regulation before we have a closing keynote address from Mr. Rajiv Sharma, who is the Research Director for Long-Term Investing at Stanford University. So ladies and gents, please switch off your phones if you can, or keep them on silent. Try and be present as much as you can be. The notepads and the pencils are there in front of you. Let's go analog for the next couple of hours. Jot down your notes. Jot down any questions you might have. Every panel is going to have an opportunity for a Q&A, so please make sure you participate as much as you can. You already know where the bathrooms are by now, but I want to tell you about load shedding. There are a couple of scheduled moments of load shedding in the area. Of course, the venue does have a generator, so we won't be totally out of electricity. But what that might mean, we might have to wait a minute or two to make sure our systems get back up. Already we've had that situation this morning, so please bear with us when that happens. As I've already told you, we have a shorter program today, so we have one tea break, and then all the way until the end of the program, then we'll have lunch. And of course, lunch takes you into Friday afternoon in Cape Town weather. I see Sauvignon Blancs and Chenin Blancs in people's minds. Out in the sun, we have a restaurant just across the road. We have a city, we have a mountain, we have a sea. The American delegation already telling me they've got big plans for the city, so please do enjoy our wonderful country for the rest of the afternoon. And take the moment also to reflect on all that came out of the conference. Without any further ado, let's go straight into our first panel. The focus here is about the experience of senior executives of not only South Africa's, but the rest of the world's major pension funds on the challenges they face. This will be moderated by Razia Ghani. She's head of investment at NMG Investments. She'll be joined by Musa Mapesa, of course, the principal executive officer and our host at the GEPF. Shafiq Abrahams, who is the chief executive and principal officer at the Eskom Pension Fund. He has nothing to do with the load shedding we're experiencing. I think it's quite important you note that. Khomutso Ramokala was the principal officer at the Telkom Retirement Provident and Pension Fund. Fernando Vinsons, who is the CIO at the Chicago Teachers Pension Fund. And Rodney June, who is the chief investment officer also at the Los Angeles City Employees Retirement System. And John Gluzak, who is the head of real estate, and member of the investment committee at the New York City Comptroller's Office. Ladies and gentlemen, a round of applause for our panel.
Thank you very much, and good morning, everybody. So welcome to this fireside chat. As we heard, it's about sleepless nights. I think some of our panel might have had a sleepless night, probably not for the same reasons we'll be discussing today. But I just wanted to say welcome to our esteemed panel. We have today with us, as we were told, Musa from the GEPF. What I was trying to ensure is that everybody knows just how influential our panel is. So what I'm going to do is go through the panelists just so you know who's who. So Musa's right on my far left. At the end there, he might be the first one that everybody may know. Next to him is Shafiq Abrams, who's the Chief Executive Officer of ESCOM. One of the things that I wanted to go through is just making sure you know how much assets all of them have. Shafiq, 195 billion rand of assets under management. Homotso next to him there with 40 billion. And then we move on to the global guys. Fernando, who's from the Chicago Teachers Fund, 11.5 billion US dollars. Rodney next to him, Rodney June, 22 billion US dollars. And then John Glusack, right here next to me, 269 billion US dollars. So just to put it into context, that's 8.4 trillion rand sitting next to us in terms of asset allocators, or 432 billion US dollars, roughly about a third the size of the JSE. So just so that you're well aware of how influential the panel is today. I think we've heard over the last day around market conditions, how unpredictable these have been as ever. We've seen quite a lot of things thrown at investors. We've had COVID, countries shutting down, war in Ukraine, hikes in interest rates, inflation spikes. Our discussion today is revolving around what gives, what is it that pension funds need to be worried about? What keeps them awake? I'm going to ask each of the decision makers to highlight some of their biggest issues, and then we can discuss each one and how they've mitigated these or not. I think it will also be interesting to start seeing the differences between our local and global markets. There are a number of differences in terms of legislation, how we do things, and it is entirely possible that we may have a solution that solves some of their problems or vice versa. So hopefully, that's what we're doing. Since we do have some visitors to our shores, I'm going to kick off with them. So, Fernando, can I start with you? What is it that keeps you awake at night?
Sure. Actually, before I start, I'd like to thank the GPF for inviting me here. It's been a wonderful experience and also eye-opening. Cape Town is a world-class city in my view after just a few days here. And last night's energy and yesterday's energy, I feel like I'm either in a New York, LA, or Chicago conference. So great job by the staff and the folks who put this together. But in terms of sleepless nights, I tell people I don't really lose sleep with regard to geopolitical issues. These are things I have no control over. I don't know what tomorrow is going to bring me. But what I can control is how we react or not react to issues. And so I make sure that our internal staff are prepared, that our internal or our twitch muscles know how to rise to the occasion if there's issues. And also we have a good understanding of our investment managers. So when something happens, we know who's going to be impacted the most. We know how they're going to react to those situations. Perfect example, when Silicon Valley Bank was taking place, I didn't even know. It started on a Wednesday. It finally just hit me on a Friday. And staff came up to me and said, "Did you see the news?" I said, "What news?" Silicon Valley Bank's closing. And so right away we just made some phone calls and figured out that we had some capital calls that were caught behind the bank. And by that Friday evening, we knew who to call. They were explaining what was going on. We had some conversations over the weekend. By Monday, I knew who to call from the investment manager side to better fully explain after the events that transpired over the weekend. And by Tuesday, I had an explanation for my trustees. So it's that type of reacting and not reacting. As we say, we're long-term investors, and so no one event should really rattle us. Even the Russia-Ukraine issue, we knew what our positions were, And by the way, there was nothing we could do because immediately the Moscow Stock Exchange froze. So it was just all about understanding what you own and being able to explain that to our trustees.
Thanks, Fernando. So for you guys, it's really about building robust portfolios through the cycle and making sure you've got an in-depth understanding of that.
That's right.
Okay. Rod, from your side, is there anything that keeps you up at night?
Well, it's much the same that Fernando just explained. There are many things that are under our control, like having a strong investment policy, a framework, making sure the trustees are always informed about what's going on, having staff that have clear instructions as to what the expectations are. But then there are other things that we don't control. Obviously, geopolitical risk, as Fernando had just explained, those things can pop up out of nowhere. Sometimes you have an inkling that things are going to cause an issue, but until it actually happens, there's not much you can do. We don't take knee-jerk reactions. We are long-term strategic investors. Our whole asset allocation is designed to endure over different sort of climate changes in the market, as well as when there are event-driven episodes such as the Ukraine-Russia incident, the war, the China technology and the Biden administration's executive order. These types of things, while they can be impactful and people are going to expect the plan to do something, I always reassure the board that we have a plan in place. We are expected to follow our plan, because as soon as you deviate from that plan and you try to time the market or try to mitigate something that happens so quickly and you don't have time to really absorb and digest it, you're going to end up making the wrong move. The markets are going to recover and you're going to be left unexposed to that area that just recovered. So it's really, to avoid the sleepless nights, it's always ensuring that you've got your plan in place, that you're prepared, you stay in good communications with the trustees, you communicate well with the staff and the stakeholders. To me, that's how I try to avoid sleepless nights, but I will say that this is a tougher market that we're in. Started off with COVID, of course, the Russian war in Ukraine, things are going on in China. Those things do keep me up at night, but once we fully understand the implications of it, if there are any, and we inform the board properly, then we move on. My job is not to adjust to the episodes that are occurring out there that can be very fleeting. My job is to have a 5, 10, even 20-year horizon and ensure that we stay on that course.
Thanks, Rod. John, anything from your side? Are you also sleeping soundly?
You can probably hear it in my voice. I may or may not have slept soundly last night. But New York City and New York State is a very different animal. So you've heard from Larry Bowsey earlier yesterday that he represents the New York City employee retirement systems. We actually have 5 retirement systems. So we have the New York City employees retirement systems, we have the New York City teachers, we have the New York City Police, New York City Fire, and the Board of Education employees, which are ancillary to the teachers. So I basically have a job of managing a real estate portfolio for 5 different pension plans, which is a big juggling act. I think I can kind of repeat some of the sentiments that my colleagues over here had. We are a little bit different because under the New York State laws, we have what we call rebalancing. So we can only have a certain amount of assets in certain asset classes. And we're allowed to go over those amounts, but every Wednesday we have a rebalancing committee, and every Wednesday, since most of our funding comes from public fixed income and public equities, we end up going and readjusting the amounts in those 2 classes to make up for any overages that we have in the private asset classes. That being said, and again, I know we're in a wacky world in New York City. We do like the private asset classes. We did increase our allocations to the private asset classes. We went for a strategic asset allocation that just came out. Part of what I look at as being the head of real estate is, real estate in the United States is the underpinning of the economy. It's estimated that this year, real estate is going to be worth $113.6 billion in the U.S. It's a source of generational wealth. It's the way that people come to the country. They work hard, they buy a house, that house gets handed down to the children and the children and the children with the expectation, obviously, that the value of that house grows. The problem with interest rates being so high is the Fed's basically stagnated the property market. Properties aren't trading, properties aren't being sold, properties aren't being bought. People can't afford mortgages, so they're basically coming out of the market. People can't sell their properties because there's less people in the market to buy. So I think we're in a period of flux where we weren't before in this market. We never had a real stagnant real estate market. So that keeps me up at night. And then certainly do the balancing act of working with all 5 pension systems, which one is overfunded and the others are underfunded. So it takes a staff of 53, an incredible amount of time to make sure that we have that money for our pensioners. Yeah. And we're a defined benefit plan, so in general we need an 8% return.
Okay. I don't know if it's worth mentioning, but the SA bonds are giving in excess of.
It's actually.
Perhaps maybe we'll move on to Musa to tell us about anything that might be keeping him up at night.
Thanks, Razia. I think it was mentioned yesterday in the last presentation by the colleague from the ICPM. It's the impact of the latest retirement reform around early access. So we call it two-component system. Yes. It's actually 3 components. As much as the legislation is necessary, the implications for our members at retirement, for me, that's the biggest concern. And yet we are sympathetic to their need to access their retirement savings, and I must emphasize, these are retirement savings and not the savings mechanism for accessing during your working life. But we have to appreciate that there is a need for them to be assisted with the economic hardships they're facing, but the impact at retirement, for me, is the biggest concern. So the worry today is, let me address my immediate challenges, but then when you reach retirement, there'll be a bigger challenge for the member and their dependents. And I think the notion, and we've picked it up in some of the engagements with our members, is what if I don't live to retirement? But the opposite is true. What if you live beyond retirement? And then we've seen most people are now living much longer beyond what is expected. The life expectancy is now going, I think it was over 77 years a couple of years ago. So the biggest challenge now is how do you educate members, appreciating that they're in financial dire straits without tampering with their future savings.
Yeah. Thanks, Musa. That's interesting. I almost think it talks a bit to Rod's point about communication, because I think it's so imperative in everything we do. Sure. In life, in pensions, in investments, but also the discussion yesterday around pension funds in general and creating that level of trust by giving members access to the money. And I almost feel like that might be something we need. We need people to trust the system more. And maybe that's a good way to almost build some of that. Although, taking into account, we know it's very tricky. Shafiq, anything on your side that keeps you awake?
Yeah, besides debating whether I would need that cod liver oil this morning or not. But let me frame it. I think for me the primary objective is about honoring the pension promise of paying the pension when it's due on an indexed inflation basis. And that requires one to think on a sustainable basis and on a long-term basis. Typically, funds cross generations, and so we have the benefit of long-term approaches. Now, to underpin that, I think everything works in support of that objective. Do you have the right investment strategy with the right asset classes, diversification, etc., the risk, the costs, etc.? But I think at the same time, for me, it's more about long-term positioning rather than short-term responses. Whether it's UK and Russia, inflation, we need to position for the long term. And what would that be? And I think sustainability, the impacts of sustainability is really the crux of how we position for the fund, right? Because you've got to think about investment returns are generated within a system. And if that system is broken, then you find that valuations expressed it gets expressed in the valuations of the company. And so we've got to think long-term positioning rather than short-term responses.
Thanks, Shafiq. Motso, looks like you're the last guy on our panel to comment. Is there anything that hasn't been mentioned yet that is keeping you awake?
Good morning. I think I need to ask the program director. Next year, can we please have our session around mid-morning? I don't see my peers who were with me last night. 11 o'clock to 12, that's a good slot.
See, it really is like New York, Chicago, and LA. This happens.
So, Babs, please, next year, can we schedule accordingly? I think my colleagues here have mentioned the default issues that keep us up. I mean, you mentioned we were almost, I don't know how many trillions you said, and that keeps us up. Just the site. Right? We are a significant player and influencer in South African landscape. So it's not by coincidence that we are sitting here as custodians of the assets we have been given. So what the gentlemen have said, the two-part system, the long-term vision is clear. We agree that that has to happen. But the one or two things that I would like to bring to the table, I mean, this is a fireside chat, it's not a lecture. I don't need to be an expert. We have actuaries, we have investment portfolio managers. That's not my job. Babs told me that we must be controversial. We must dare debate and discussion. So I think that is the brief that I want to start from. So quickly, what I would like to see going forward is how do we ensure that we collaborate? How do I leverage off PIC, EPPF's investment managers and decisions in my board? Chairman is right there. Is Dondo having discussions with my chairman to say this is what the country needs, Komoto? You are a part SOE. We are independent. We are profit. But you know. But are they having those discussions at that level? Yeah. We're having a discussion. Many. I can't remember with who. And we got stuck at, is it collaboration or collusion? Where are we as pension funds in South Africa? These guys have developed the blueprint. We are slowly but surely starting to get there and engage. And it's not by coincidence that we are sitting here. The discussions that we have are not starting here. But how do we then see that vision to collaborate and respond to the country's needs? John mentioned when we were prepping that it makes it easier for them once pension funds have skin in the game, right? Before they can then allocate. So how do we have those discussions? How do we educate our trustees and move them away from soccer tickets?
Yeah.
Right? Correct. So that briefly for me is what keeps me up. Thanks.
Thank you, Motso. That is interesting. I mean, I think the difference with collaborating and colluding might be if you benefit personally, right? So if that would then be probably leaning towards collusion rather than collaborating. If you have the right purpose and the right intention, and it's all about benefiting members, then very likely it's collaboration. So maybe we should try and set some criteria so we know which way it's going as a starting point. But that's very interesting because I think collaboration across the industry is so important in terms of just getting the best out of what you can do. Like you can leverage off what everyone else is doing. And I think there have been a couple of forums, kind of trying to launch itself in that way. But even this type of forum is a form of collaboration because we can now find out what is happening, across the pond. What are they doing? Is it better? Can we leverage off that? Which is also something that I don't think we used to do for a long time. So I think even this type of forum helps us. But maybe we can touch on a couple of issues that happens in SA. One of the things that I wanted to touch on was something the Minister of Finance did not want to talk about yesterday, which is the increase in offshore allocation to 45%. And what I found interesting about that was just to check, firstly, what the local guys have done around this, if anything, and then see the equivalent from our global counterparts, because I think it'll be interesting just to know, what's happening on both sides, given that we have very specific regulation around this, whereas globally, there's no real regulation in terms of where you can invest. You can invest anywhere, and just seeing how people, invest, given that. So maybe, Humotso, we'll start with you, since you're still a bit warmed up. We'll give you a break after this one.
Can I not give it to my leaders in asset size first?
Okay, let's start by size. Seems like the men like that better. So, Musa?
Thanks, Razia. So I'll speak as the largest pension fund in Africa. Yes. And South Africa. Look, because we follow a liability-driven investment approach, the asset allocation is determined by the complexion of our liabilities. So we, whether it's fortunate or unfortunate for us, we don't fall under the Pension Funds Act, so Regulation 28 doesn't apply. So the 45% offshore limits don't apply to us, and our current strategic asset allocation allows us just shy of 20% offshore, well, outside South Africa allocation, including the rest of Africa. But we need to balance that with, firstly, our liabilities are rands-based.
Yeah.
So to the extent that we need to chase alpha, as the chair of the PICIC was mentioning yesterday, we need to balance that when we repatriate these funds, we need to convert them into SA currency and still pay benefits in SA currency. And I mean, the GEPF, in our annual reports we've reported over the years, we've managed to withstand some of the economic shocks globally. 2008, we've seen that in 2020 as well. Because of our long-term strategy, we're able to withstand some of these shocks and remain above our liabilities in terms of how our assets are performing. So balancing the two between sending money out of the country to chase alpha, good returns, as well as keeping a good proportion of that in SA is important. For a fund our size, if we were to externalize up to 45% of the investments that we hold, it will definitely disrupt the SA market. So that context is very important from a big pension fund, Humotso. Yeah.
We'll move on to Shafiq. You guys are obviously subject to Reg 28, so the 45% does apply to you.
Yeah. So let me speak as the largest standalone private fund. So yes, I think like Musa says, the liabilities drive the strategy and what the allocations would be around. And so if it's rand-based, you're going to be influenced by the currency you're going to look for. And so we are at 36% of that 45%. And it's before the regulation, together with Africa, we were quite close around that number. 30 plus, about 3 in Africa. If you take it to now, after the regulations, about 36, and we're staying there for now. But I think we also must debate this point, and I think it's a controversial point, but we also have to accept, and we see, should you have allowed this or not allow this? As a pension fund with so much volatility, what you need is options, right? And I think whether we'll exercise that option or not is debatable, but you need options to be able to look for alpha. And I think that's the positive side of things. Maybe detrimental for the country in terms of outflows, but it's something we're going to have to grapple with as well, as a country as well.
I mean, while it may be detrimental in terms of outflows now, it does mean, if people remain in SA, they still retire here, so it comes back eventually. I mean, it's a long-term game, I guess, as is pensions in general. But, Motso, you ready to give us some thoughts?
The beauty of these conversations is it recurs. It's a recurring theme, and I'm enjoying this opportunity because it's almost like, we are married. When the relationship is good, you can finish each other's sentences. Not that I want to marry the largest, but let me speak as the enabler of us having these conversations as the largest infrastructure telecommunications provider in the country. I think that deserves a clap, at least. Right, so just to bring it back into our focus and context, right? My member doesn't care where the money is going. He doesn't understand a negative number on his quoted statement, irrespective that I've got a DB underpin as well. He doesn't care. He sees that his benefit is 49,000 rand less today because of what has happened in the last 4 weeks. He doesn't care if his money is with, who am I going to pick on this year? Okay, let me leave the zebra alone this year. Who am I pick? NMG. He doesn't care that his money is at NMG as an investee. All he wants is a return. Whether he gets it here or offshore, it's irrelevant.
Yeah.
But it's a bigger discussion for us as allocators. I am really saddened because I can't see them. Yesterday they were very vocal and how they're going to challenge me, my peers. You see, that's why the timing is important of when do we have these conferences. Is Ndawana here, Leslie here? I can't see him. He's one of them who was very vocal about this discussion and how we must develop our local industry. That's where the decision becomes technical.
Yeah.
It's not just about return, it's what is the impact long-term that you are having on the local industry. What happens to Perpetua that I'm supporting to grow their global fund? What happens to Benguela? What happens to those guys that I'm trying when money is leaving offshore, right? So I think that is the perspective that I want to bring in addition to my leaders here.
Thanks, Motso. I think that's important to realize that whether we like it or not, you are the stewards of those assets, because actually the members don't know enough to be able to make these decisions on their own. So they do need people who are genuinely thinking about it and doing the right thing on their behalf. Shall we, Rod, I'm going to pick on you if you don't mind. Can you tell us about your global kind of local splits and how you think about that?
Yeah, be happy to do that. So at Lacers, we have, of course, our assumed rate of return, which is 7%. And then we have our funded status. And we are not at 100%. We're at about 70%. Not where we'd like to be. We wish we were higher on the funded status side. But the fact is that we're 30% under. We have a plan to become fully funded in about 24 years. So in order to do that, we have to take on more risk. We have to achieve that 7%. We'll never get to our fully funded status without taking on more risk than some of our peer plans who are higher funded. couple of our peer plans in the city, because there's 3 plans. There's our plan, there's the utility workers, which I think they're like between 90 and 100% funded, and then the fire and police pension plan, they're over 80% funded. So they take on less risk. They have higher proportion of their listed securities in U.S., which is considered a little bit lower risk, lower return. Our plan of the 3 takes on higher risk, and we are, as a consequence, we have a higher proportion of our listed securities outside the U.S. in what we call the non-U.S. markets. Of that pot of the non-U.S. markets, so it's 30% to non-U.S. listed, 25% of that 30%, which translates roughly, it's about 7 to 8% of the assets are in emerging markets. That's a far higher exposure to emerging markets than any of our peer plans and most of the California plans, because there's about 30 plus public pension plans in the state of California. Our plan probably has one of the highest non-U.S. allocations. And that's by design. And I get a lot of needle poking from other CIOs. Why is your non-U.S. and your emerging markets exposure so high? It's because our funded status is lower and we have to take on more risk to try to catch up. I can't say that's very desirable, but it's the situation that we find ourselves in. So we do what we can. The other part of that conversation or the equation is also the city of Los Angeles that has to put in money as a contribution to the plan. So there's 3 sources. There's the members. I'm a member of my own plan. I contribute 11% of my salary to LACERS. Then there's the investment performance that I and my team and the investment managers, that we're all working hard to generate the returns to pay benefits. But whatever I don't make up on the investment side, and of course I already mentioned that the members have to pay, the city has to come in and make up that difference. So to help minimize the contribution from the city, and these are all political types out there, we take on more risk. Now, unfortunately, our non-U.S. exposure, particularly in the emerging markets, has not fully been realized. I know that every asset class has their day in the sun, and we've been in the emerging markets with a fairly high exposure over a long period of time. That has not played out, meaning that we haven't generated the returns given the amount of risk that we've taken. And we all know this is a risk-return proposition, right? If there's one thing that does keep me up at night, in addition to the things that I had already mentioned, is constantly thinking about the additional risk that we have to assume, and are we going to be rewarded for it? And that's not something I can predict. We have to go on experts that we hire, our consultants, rely on our investment managers and the expertise of the staff to ensure that we do everything we can to generate these returns. And despite the fact that I have a preference to be more U.S.-centric because I understand those markets better, that's not necessarily the right thing to do. Just because I have this bias doesn't mean that that's how it should be played out for the plan. Our fiduciary responsibility is to the members. And so I have to also rely on other experts out there to help determine what is that right allocation to U.S. to non-U.S. And for our plan, we have a higher weighting to the non-U.S. listed side. Even in the private markets, we do have probably more non-U.S. investments, not by weighting, but probably higher than I would like. But that's where the opportunity set is. We're always trying to find the best opportunities with the best managers. That means we have to look outside the U.S. because the talent is not solely in the U.S. It's throughout the world. And what I've learned from being at this conference is that there's an untapped market here in Africa that we are not invested in. And I would like to tap into that market after I get more education have more conversations. So I think the future for Lacers is to continue to invest heavily outside the U.S., but to do so very thoughtfully and carefully after we've educated ourselves, and particularly our trustees. They have to be on board. And while I'm sitting here, I wish some of my trustees were here as well, because unless you hear this firsthand and unless they get on board, everything that I say to them will be meaningless unless they also are sold on the idea, because this is what's best for our members.
Thanks very much, Rod. I think you've touched on the natural kind of home bias that most investors will have. So I think the fact that we've moved up to 45% offshore really almost puts us in line with what global funds would be doing anyway without any restrictions. So I suppose there is that option, as Shafiq spoke about, that you can be at 36, but should something happen that we decide actually 45 is the right number, you actually have the option to go there. But yeah, so I think that's quite interesting. And then, Rod, you also touched on another thing, which is private markets, which John also spoke about earlier. And I think that's also been something quite topical here. We've had regulation changes, I believe last year, that increased private market exposure up to 15%, but we haven't really seen all funds taking up that, taking the exposure up to that maximum. Could you talk a bit about your private markets exposure in terms of how much it is, how much it makes up, and how you're thinking about, are there any things you think about in terms of how much exposure you need in that? So taking into account your all DB funds, I think a lot of the concern sometimes stems from the fact that in SA, we predominantly DC, a lot of funds up to a certain point allowed members to resign and take their full benefit at that point. And so you needed to have liquidity at all times, or whenever required. If somebody resigned, you need to be able to give them their money. So if you're in private markets, you might have you'd kind of be locked in. You'd need to think about how you deal with that. Do you pay somebody, 70% and then keep back 30% until you can realize that, or increase your exposure for everyone else and pay them out fully? So maybe you can touch on, it's quite a number of of areas. I'm going to look at you, Fernando. You've been a bit quiet. Maybe you can just talk to us a bit about your private markets exposure, the type of things that you're looking at, and then, if there are any liquidity concerns, I suppose.
I think I'll start with the history a little bit of what's going on with our plan, because we have been in private equity since the 90s. And our exposure today is for total alternatives. What we call alternatives includes private equity, infrastructure, and real estate. We're about 16% target. We're over allocated, so we're definitely over 20%, and we're even adding private credit to the mix. But the bulk of our assets are still in publicly listed. Having said that, the other pressure for us is similar to, but he's in an even better position at 70%. We are at 47%. It's one of the issues in Illinois that we're grappling with, along with New Jersey, I believe, is the other state. Most of the funds, public pension plans in Illinois, are severely underfunded, especially the city plans. And it's not out of original design. There were some decisions that were made at the local government level that contributed to the impairment, current state that we are in today. Frankly, in years past, when teachers wanted a raise and the city, it's not a revenue generating from the standpoint of like a company that can just say, hey, sell more product. A city can't say, well, let's just, raise taxes. That doesn't go over very well on a weekly, daily, or any basis. So they looked to the fund at that point and looked at some of the pension funds that were in the 90s. Chicago Teachers was in the 90s, and said, let's take a pension holiday. Let's stop funding it, and let's give the teachers raises. And I was telling someone this, I think they said, when it dips below 90, call us and we will fund it back. The phone rang below 90, put it on hold. The phone rang again at 80, put it on hold. The phone rang at 70, put it on hold. The phone rang at 60, put it on hold. Finally, a lot of people said, I'm coming to your door. And that's what happened. And so the structure today is the city and a lot of the local governments have put in writing that they will make good on the promise. The question is how? That hasn't been figured out yet. So what does that mean for me as the CIO for an underfunded plan? That can't keep me up because there's no way I can really, short of returning plus 60% every year, which is impossible. I can't worry about it. I have to rely on the fact that they'll figure something out. But I also do have to still deliver on returns. Our assumed rate of return is 6.5%, so that's our hurdle rate. I have, as opportune last year, time for me when I came into the plan to challenge the consultant to say, let's take a look at the overall asset allocation. Does it really make sense that we're 50-50 with domestic and international? And we saw that the MSCI world is actually 60% US, 40% international. And I wasn't comfortable. I have a little bit of a history as a pattern reader from my days on the buy side. And I said, okay, I've seen what international has done. I understand the diversification benefits, but I also have seen with historically what it can do. And it just, a lot of the managers kept telling me, but it keeps getting cheaper and cheaper and cheaper. At what point does it really become, deep value that, it's only going to be right twice a day? So I said, let's rebalance that 60-40. So we went more 60-40, 60 domestic, 40%. And I'm not the type to double down the cheaper it gets. I think that's a Vegas bet. So I have decided, again, 60-40, and then where we're under allocated. And there's some new opportunities as well because rates have gone up. So again, we've introduced private credit. That's an additional 3%. That's where new money will go. And we're over allocated in private equity, but because we're long-term investors, we have over 90 partnerships, active partnerships. On any given year, we have re-ups. And so all of our new deployments are going more toward re-ups. We actually also are invested in 2 Africa funds. That was not a decision that I made. It was a predecessor, but I hope to continue that. And I told someone, a year ago when I came into the fund, I knew only of 1 Africa fund. Fast forward to today, I think I have a Rolodex full of Africa-focused funds, so the future's bright.
Thanks, Fernando. Definitely good to hear. I think just for our audience, when the global participants are talking about international exposure, they're talking about anything outside the US. Whereas when we talk about international, obviously it's anything outside SA. So just to make the clarification. So it sounds like you guys are all actually quite high up or overweight your private equity or private markets allocation. John, do you want to comment a bit on that in terms of your funds?
Yeah, sure. But just, I thought when you said you go by size, you'd go by me first. But we did just meet, so maybe that's. So
up to you, John.
We can continue on size if you want. We are a very large investor. I mean, our smallest investment is about, in my book, is $250 million or up. But I think, what we have is a similar situation. We were talking earlier, and back in the 70s during the fiscal crisis in New York City, the pension plans actually bailed the city out by loaning the city money. So there is a lot of cooperation among the plans in the city. But getting back to the actual question, every year we go through an annual plan. Every year that annual plan includes a forecast of calls and distributions for every asset class. And that actually helps us set the parameters on which we're going to invest for the rest of the year. And actually, we usually run a 3-year and a 5-year annual plan. So we have a lot of guardrails that are in place. That annual plan is also driven by, I think I mentioned, and we all do it, our strategic asset allocations, which we're just finishing up this year. We have allocated more to the private sector. Once the rebalancing law was raised, we're actually putting more into privates. As you can imagine, private equity gets the bulk of that.
Yeah.
But between private equity, private real estate, infrastructure, opportunistic fixed income, and hedge funds, we're going to be about 40% in privates. So, quite a lot. Within the other buckets of public equity and fixed income, that asset allocation also drives how much is going to be ex-US.
Yeah.
So even in public equity, we only have 5 fund managers that are ex-US. Part of it really is, again, that understanding of the ex-US markets where, we know what our domicile is, we know what the performance is there, so we tend to stay within our boundaries. However, in my portfolio, we actually have a fairly high concentration in ex-US. So high concentration for us is I have 12% in Europe, and I have another 4% outside in Asia. We don't have anything in South Africa. As I said, unfortunately, it's a matter of size for us, and it's just difficult to take $269 billion in a plan balance and invest in smaller chunks. It doesn't move the battleship.
Yeah.
So it's very difficult. But of course, we work with consultants. If any are in the room, I apologize, but I don't think we really need them. We have a professional investment staff. So so there you go. Actually, when I interviewed him, the then CIO said, "You've been around for a while. What do you think I should do?" I said, "Fire your consultants." And he actually said that's easier said than done because this is New York City, so there's a lot of people involved.
Okay. John, sorry, just in terms of underfunding or how funded your plans are they, I assume there's still some underfunding?
It varies.
Okay.
One of the newer plans, which is the Board of Education plan, they're overfunded. So,
yes. Sorry, I remember.
yeah. And then some of the other ones, the teachers and the employees are fairly well funded. Police and fire, they are underfunded quite a bit. But when you think about the jobs that these people have, and we had the September 11 attacks, and right now a lot of them are passing away. So they're not being replaced by the younger generation because they're looking at it as a dangerous job, and the salaries don't really start that high.
Yeah.
And you have to live within the city of New York, and if you've been to New York or you know anybody that lives there, the rents are too high.
Yeah. So I think maybe it's based on what Fernando also mentioned in terms of funding being underfunded and the city, the pension fund helping out the city. Maybe just something for us to bear in mind in terms of our local funds, because I think we are relatively well funded because we're funded, separate from the city and separate from the government. And probably worth bearing it in mind if we ever faltered and decided to, open the coffers, I suppose.
It wasn't free
Pension
money.
fund.
It was a loan that the pension funds gave to the city, so it wasn't a gift.
And it was repaid in your case?
Yes.
Okay. But Fernando's still waiting. He's knocking on doors on a daily basis. Yeah. So I
we
think
have
it's
to-
certainly.
I mean, it's a fine balance because we have to definitely keep our foot on the pedal. We
Yeah.
have to have an eye towards higher return generating assets, but we also have payments to make. So, and at some point, if they don't refill the coffer, we may have to get out of those longer locked up assets. And then that becomes a much faster downward spiral.
Yeah. Okay, I think the one thing that we haven't touched on yet was responsible investing, obviously also very topical. We had a couple of topics on this yesterday in terms of climate change and gender lens investing. And Fernando, I'm going to start with you again because I noticed the Chicago Teachers Fund had almost 50% invested within MWDBE funds. For our local guys, that stand for Minority Women and Disadvantaged Business Enterprises. So it's quite interesting because it's obviously something we focus on quite a lot, but certainly I had it in my head that that's because we have a legacy issues that we needed to correct. However, it turns out that globally, in very developed markets, they're still struggling with representation. So could you expand on this, why it's important for your fund, and I think importantly what your criteria is to select providers in this category?
Sure. I came into the industry in 2009, and at that point already, we had these what we called Senate hearings. There were the state senators that would invite every pension fund in Illinois every year to come and present in a very public forum like this to ask, what are you doing about investing with minorities? What are you doing about investing with women? And we have to actually spell out every number. How much are you trading with minority and women-owned broker-dealers? It's as open as it gets and as contentious as it gets because they challenge every number. And Illinois, in the pension code, every plan has to have a defined target defined by the individual plans themselves as to how much they're going to invest with minority and women and disabled and disadvantaged business enterprises. So we have those goals, and that's why teachers is at 48%. My prior plan, we were closer to, I think, 38%. So everyone is aware in Illinois, and there are targets. Emerging managers in Illinois is an investment manager that has no more than 10 billion in assets. And they purposely did set the target at 10 billion because even at 10 billion, I mean, I've seen investment managers at 5 billion that couldn't keep the lights on and had to shut down. And so they understand that even 10 billion is nothing relative to the entire industry with the likes of BlackRock, Blackstone, KKR, Franklin Templeton, all those guys, they're behemoths. So to compete, you know, there were even talks about moving that line or that target or that AUM to 20 billion. So it's something that we're mindful of. And how we approach it is, again, we talk to as many folks and we come to as many conferences to meet all the new firms that are incepting out there. We're seeing a lot more on the alternative side in the U.S. I think that's where the next generation is coming from. Also at Chicago Teachers, in fact, today is one, and I have to be attending it starting at 4:30. We have what's called the First Friday. Every other month, we invite MWBE firms to present direct to our board. There are the investment consultant is there, all of the staff. So it doesn't necessarily result in an allocation, but it does introduce firms that we've not heard of before to present directly to our board. I got to tell you, a lot of times the board trustees will call me the next day and say, how come we're not invested with those guys? And I say, whoa, whoa, whoa. We have to go through an RFP process. There has to be a need. There has to be a matching process. But at least it gets them exposed. And actually the last one that we did, in August, we invited DPI and AFIG because they're already in our stable. They presented, they gave performance updates, and we also invited two other funds, Sango and Bayless, to present. And there were questions. Well, what about Africa infrastructure? What about Africa renewables? So it got the conversation rolling, and that's probably something that I'm going to put in the calendar next year.
Okay, thank you. Rod, I know you guys have a slightly different approach, but maybe you could just very quickly highlight it for us.
Yeah, I'd be happy to do that. So we have an emerging manager program, and it's gone through various iterations over the last 20 years. But in the state of California, we have what's called Proposition 209. And Proposition 209 is what I'll characterize or call an anti-affirmative action law which precludes plans in California, and I'm talking about the public pension plans, and I said there's like close to 30 or so, and the University of California plan. We cannot select investment managers or have contracts based primarily along gender, ethnicity, or race. It doesn't mean, and this is according to interpretations by whatever attorney is advising the plan, it doesn't mean that you don't have to, you can't consider it, but it means that performance-driven metrics have to be the primary driver of why you select managers. So, again, depending on which legal counsel you have advising the interpretation of Proposition 209 to your plan, and our city attorney for the city of Los Angeles advises our trustees, we take a very conservative approach. So we are out searching for managers. We want to get to know small managers, and that's really the definition of our emerging manager program, or how you qualify is you have to be basically a small manager. On the public side, it's assets of less than $2 billion for your firm. If it's, for example, private equity, it would be a first time, a second time, or a third time institutional fund. But there's no mention of minority, ethnicity, et cetera. That doesn't mean that it's not considered. When staff is out talking to managers, I mean, our eyes can tell which firms may have a higher proportion of diverse talent within their organization or who the owners are. It's just that we don't document those types of things publicly, or they're considered due diligence materials, which are protected by the state of California. But we do tread very carefully. The understanding from our board is that we are looking for the best talent out there. And we recognize that a large proportion of the managers who are highly talented are not white, male, Caucasians. You know, they are people of all different, races, ethnicities, genders, et cetera. But what's more important than just the way people look or what gender they happen to be is really what I value, and this isn't codified anywhere in our policies, but I value diversity of thought. To me, what we're trying to do is find the best thinking out there, the people who have the best ideas, and that comes, I think, regardless of gender, race, ethnicity. That's not to say that people of color or different genders don't bring something different to the table, because they do. I think everyone's got certain baggage depending on your upbringing. But at the end of the day, when I'm talking to managers and part of the due diligence conversation, I'm really looking for how different is the thinking and what do they bring intellectually to their firm and ultimately to the benefit of lacers. So diversification, that's what we all preach in our business, right, in investments, is diversification. So having diversification even with the people who we do business with, the investment managers that we hire, what their staffs look like, what their board looks like, what their rank and file look like, it's all very important. And I will add that in recognition of that point about diversification, we did institute what's called an organizational diversity survey. What that does is any firm that goes through our process, the RFP process at Lacers, or even private equity firms who we ask to voluntarily fill out the form, we ask for the composition by all different ways to slice and dice, but ethnicity, gender, race, sexual orientation, et cetera, at the board level, the senior staff level, and at the rank and file level, and to fill out that information and turn it into us. The difference of how we get around Proposition 209 is that those organizational diversity forms are never seen by myself or my staff or the board. They are sent to another division within our department at Lacers. Those staff who are not decision makers in the investment process aggregate that information and present that aggregated information back to our board. So our board gets a sense of what our managers in the aggregate look like, but not anything along individual managers. So we do value diversity, we do capture it, we do research around it. These are small baby steps, and I think we are demonstrating progress, but we still have a long ways to go. And trying to work around Proposition 209 honestly has been extremely challenging. It is one of those things that keep me up at night.
Thanks, Rod. John, I think you guys have a slightly different approach. Can you talk us through that in terms of how your selection is done and what your criteria are?
Sure. We actually have an approach where we use a third-party manager, and a lot of it is driven by what Taffy's doing. We just worked on re-upping some of those contracts, but we initially had a bar of $1 million or no more than 3 deals, and then we realized we weren't capturing a lot of the funds out there, so we just raised that to 4 funds and $2 billion. But it sounds like we're still a little bit under the bar that my colleagues here have set. So Taffy helps us source a lot of the diverse talent and the diverse managers. We have a real commitment in the city to increasing that diversity. Oddly enough, well, not oddly enough, but in Europe we can't, because in Europe you're not allowed to ask what your race or your gender or your sexual orientations are. So most of it's focused in the U.S., of course, and I think just from my experience, we've made a lot of progress. Right, when I was on Wall Street back in the late '80s and early '90s, there was one female brokerage firm out there, Muriel Siebert, who's no longer around. But the trick that they used to do is to take one of their high-performing traders off of one of the desks and then seed that minority person. So then we can actually come back in, and when we're doing government asset sales, we can go in and say, look, we have a minority partner in here. So the whole straw man mentality, thank God, is out, and I think we're on a much better path, going forward. I mean, myself personally, when I leave New York City at some point, I want to leave it in the hands of somebody that doesn't look like me.
John, sorry, could you just touch on very quickly criteria that you use to choose them? So normally it's something like 51% ownership, etc. What is the criteria that you guys use?
I might have to look at Taffy to make sure that I'm getting these correctly, but one of the things we did, it is 51%. We've just started looking at carry, because not only is it a matter of who's on the board or who's the decision maker, we want to know that that person that's involved in investing the money in the fund actually earns carry from that fund and isn't a picture on an organization chart. So that's something that's important. I think
Okay.
Public equities, sorry. Okay, so for the private markets, it's currently 25% ownership by a woman or person of color. We're getting board approval to increase that to 33%, which is roughly the industry standard in the US. For public markets, we're at 51% ownership or control by women or people of color.
And when John was talking about carry, is that 51% of economics? So that? No, so it's 25%. Ownership, okay.
For carry, it's currently 25% and then looking to increase it to 33%.
Okay. Understood, thank you.
She makes me look better every time we work closer and closer. Every time we work closer and closer, it's a good thing, because she finds a lot of managers that would never even know who to call.
Thanks, Taffy. Sounds like you're doing a great job. Maybe we're going to speak to our local guys, because I think obviously this is something that we deal with on a fairly regular basis. Could you just touch on, what your thinking is and strategies in terms of supporting smaller managers, emerging managers, or even how you define those, I suppose, is important.
Are you starting with the biggest one again?
We thought we'll go from the bottom up this time, Kamotso. I'm going to go to the middle. Let's start with Shafiq.
So we've got two programs, and I think it dates back to about 2011 where we started with the program to support emerging managers and black-owned managers.
Yeah.
Currently, about 60% of our mandates in domestic markets are black owned companies, and we look at owned and managed, and we look at the remuneration structure, equity structures, et cetera, et cetera. In order to enable that, in the past, we had two programs, two development programs, the listed side, and more recently, the private market side. In private markets, a little bit newer, we've got about 10 managers in the program, that's part of the program. But I think where we are right now is around women-owned asset managers. And that number is set in anyway by about 10%, right? Now, we recently published some research that helped us to understand what are the barriers to the advancement of women within the asset management industry. And it really, and I say this, why we did that exercise is it was becoming a target exercise. And so when you say 10% and you say, no, this is not, it's too low, it must be like 50%. The question was, there are no managers that you could access, and that's the response. So our thinking was, let's rather go back and understand the barriers to entry and the impediments to the advancement of women. And that study was quite definitive in terms of helping us understand that. The next set of work we'll do is to understand what initiatives we're going to put in place to advance that representation of women and women-owned businesses within our universe as well. And I think that most probably will inform our next development program and how we're going to do that now.
Okay. Thanks, Shafiq.
Right, I guess I'm next then, right? So, listening to the conversations that our guests have told us, right? Yeah. We are not far off as South African pension funds. I think we're just not harnessing our power and influence to what the country needs.
Yeah.
Being the smallest, I can piggyback off of the bigger ones. Right. So I think the point for me is Shafiq has got a developmental program. I have a developmental program. Well, not me, but the TRF, the Telecom Retirement Fund. So, how do we then stop developing? Right? For how long am I going to develop Kilebukhil? Right? For prowess, for example. Not that they're not good to be a big manager. I'm just using them as an example. That empowerment, diversity, inclusion. What is TRF's 200 million and Musa's 300 million and Shafiq's 200? How do we move to get you to that large asset owner? How do I get Fernando to believe in my local asset management companies? How do I get John to allocate a little bit more to South African managers? Right? For them, they basically told you are too small to worry me. That's what they're literally telling you, that I don't have time. And what is the need? What is the call as a South African investee, as a South African? And I'm sitting here and I'm listening. What are you lobbying? Huh? Who are you having these discussions with? You can't keep coming to me and GEPF, ESCOM. There is assets elsewhere that the country really needs. Right? And that's what I'm hearing. Okay, I'm not scaring you, but they said this must be sleepless conversations. So let's have those conversations. Let my chairman speak to ESCOM's chairman. And then they come and say, look, this is what we've agreed. Right? As a committee of pension funds, this is where we need to put 1.5 billion into this asset class, that asset class, so that the international investors can also come in and add another $1.5 billion. What stops us from having that conversation? So we're not far off, but our industry we're maturing, I think, as South African representatives. I mean, have a look at the qualifications of the people that are sitting on this stage.
Yeah.
Yeah? It's no longer the guy who has the biggest mouth, who's a principal officer. We're not a post office anymore to just send and sign documents. I don't sign rule amendments for a living.
Thank you, Humotso, for clearing that up. Musa?
Yeah, thanks, Razia. I won't repeat what my colleagues have mentioned. We've got a similar program. The PIC mentioned yesterday what they're doing. Chairman of our board indicated our transformation policies. But I think the challenge to us as asset owners in South Africa, as well as asset managers and consultants, is what do we need to do as South African role players and African role players to create an enabling environment that will give the confidence to our colleagues from the US and other jurisdictions to come and invest alongside us.
Yeah.
I think that's the challenge.
Yeah.
John has a bigger checkbook. We can create or actually collaborate, which is what Humutso was talking about earlier, and give him a big enough challenge to match whatever it is that we may be investing in and de-risk it enough for him to have the appetite. So that's the challenge to us to create that appetite and the confidence that they need to invest in our country. Yeah.
Okay, we've already been given a time call, so I'm going to try and wrap it up a little bit. Because I think we could go on for hours. We heard the finance minister assuring us that the country is a going concern and it's in very capable hands. So we know South Africa and its solvency can't be giving anybody sleepless nights after that assurance. I suppose the question for our visiting panelists, and based on what Musa and Humotso are saying, what would you say is required for funds such as yourselves to feel comfortable to invest in a meaningful way in Africa? What is it that you think you need to give you that comfort to invest here? And that can also be collaboration in terms of, working alongside a GEPF. Maybe John, with the largest checkbook, you're probably most in demand, yeah?
Sure. Musa and I are going to talk later. I think there's other ways that we can potentially work together. Currency is also a big risk for us that we have to try to abate. And the great part for me about coming here is I met other people that can help me with that and can help me with the currency risks. So it's a matter of education, both for my trustees and, quite honestly, the consultants. I'm not going to tell you once again how I feel about them, but a lot of them don't pay attention to Africa. And a lot of times when you talk about investing in Africa, it's the Wild West. There's always, crazy things going on. There's rule of law that's a problem, and it's not really that. So, for me personally, this was a great trip, and hopefully, we can get a consultant to come down next time.
Thanks, John. Rodney, your views? Your thoughts?
I totally agree with what John said. On all accounts, it does start with education, and I want to thank the GEPF for bringing me down here to share ideas, but also having the opportunity to meet so many wonderful people, but smart people who know what they're doing. I don't think that is so well known, like at least in California where I'm from. Farther away geographically than Illinois and New York. We don't have a large presence of Africa, anything in California. It's very much out of sight, out of mind. So coming down and getting sort of firsthand look and feel, and we could call it like looking under the hood or kicking the tires if you're buying a car, I think that's where it starts, is having those conversations. Definitely step one. But like John said, consultants, it's kind of a love-hate relationship. Maybe it's more of a hate relationship than love. I totally agree. I don't think that public pension plans that have a sizable staff necessarily need to have consultants. We do have them for fiduciary reasons, and that's a whole other conversation that I won't go into here. But until the consultants get on board and understand what the opportunity set here is and understand the risk and return profile, it's going to be very difficult, no matter what I say to my board, to have any traction unless the consultants are on board. I'm going to go back to California and speak with my consultants about what do they know about Africa? What have you done to learn more about the opportunity set here? Are you depriving Lacers and our members of phenomenal risk-adjusted returns because you're too lazy to get on a plane and meet people? That's what I think's happening. So I've got some conversations to take back, to California and with our consultants. But I do think it starts there. I really would love to see our trustees get on board. And I have one of our 7 trustees that was like a cheerleader for me to come down here because I have to get approval from the board to travel internationally, and full support from this one trustee. You go down there and find out what the opportunity set is and come back and tell us. So next Tuesday, I have a board meeting. I'm going to share my experiences here and all that I've learned, and hopefully that will entice them to take greater interest in this continent.
Thanks, Rod. Fernando, what will give you
Yeah, I echo all
comfort?
those sentiments about education as well. And something I thought about last night, and I started repeating it among other people, but if I go to my consultants, I say, I'd like to invest in Asia, the next question is, well, where? But if I say, I'd like to invest in Africa, they don't even ask that. They're just like, right? So there's that kind of, hey, you might want to rethink that sentiment and maybe go to that next level and say where and understand where. But I'm going to turn it around a little bit, and something that we've done in my prior fund, and I challenge the gentleman to my left, is maybe what one way to go is to pick a handful of winners, or not a handful of winners, a handful of firms to grow so that they get to the size that when they come to the U.S., they're at that size where, I don't want to say, they're already, I'm sure they're all institutional quality and level, but it's the size, because for John's size in terms of the fund, the checks that they write, they don't want to be concerned about owning 50%, 75%, almost 100% of the fund. We did that in our program at my prior fund, where we said, there's a handful that we're going to identify, and we're going to grow with them. We can't spread our check, especially the checks that we write, with everyone, but we can certainly pick out some of the ones that we have high conviction in and grow with them, as long as that conviction remains the same, right? Yeah. So meaning to say, the performance is there, why not partner with them from inception to growth to full out of space trajectory?
Thanks, Fernando. I see for Motso's.
I'm being challenged.
Yes.
We are so samanje ndoda. We susile. You've literally, what is it? Stirred the hornet's nest. Right? That's what the problem is not institutional investors. It's the other guys. They don't like being cooks. They all want to be chiefs. So that's why I said we are so samanje. You've really now. You see now, we should be ending, the time is gone. and you are touching on a discussion that is broader, but it is for us later, bigger, right? I think we need to wrap up. The only thing that I'm sad about is when the president has his infrastructure target, there's pledges and signings. These guys are saying a lot, but they are not pledging.
Yeah, perhaps the collaboration amongst the larger firms could also help, because
Correct.
If each one chooses 5, there's at least 15 that get supported until they, reach the stars. So we've only got about 2 minutes left. I'm going to put one lucky person to ask a single Oh, okay. First hand up, so I guess it's up front here, if you don't mind.
Thank you very much. Carolyn Chalmers, EPPF Independent Committee member and on the board of the Chapter Zero Southern Africa with Dondo. My question really is, it's an observation, I'd love to be here same time next year. We are in a climate crisis. We are dealing with infrastructure failure as a result of weather events. And what's not keeping our pension funds awake at night is the engagement and about climate and use of fossil fuels, and that engagement bearing fruition. And I'm not hearing that. And I'm hoping that at next year's event, same discussion, that is actually going to be keeping them awake at night, because it's not an emerging issue, it's an immediate issue. And I understand that there's geopolitical, etc., but this is impacting daily life at the moment, fires, floods, etc., infrastructure investments, infrastructure impacts. So maybe that's just a question to the panel, is why wasn't that a top priority, what's keeping you awake at night? Why is there, and I understand there's a balance between divesting and engaging, but we're not seeing the fruition of engagement. We are still seeing the sassels in the investment pool, and we're not being more assertive in our engagement. So why is that not keeping the panel awake at night? Thanks.
Thank you. Panel members, I think we touched on a bit of this climate change yesterday for some of you that did comment. So I know that it's an issue. It may not be keeping you awake, but perhaps you could just comment very briefly, just to talk to what you're doing and why you sleep comfortably, because you perhaps got some exposure to it or trying to mitigate it in some ways. John is closest to me. I'll start with you.
Yeah, I think it is very important, and we, being a government entity, we have set certain goals for ourselves. It's difficult to move the battleship. We are a battleship, and when you're of our size and you say, okay, we want to put 10% in, we want to put in, 15%. Well, 10% is $27 billion. That's a tough interest or a tough nut to kind of fill. I mean, we'll get there eventually, but it's turning the mothership around.
Okay, thank you. Rodney?
I'll say, briefly, it is very important. We do have an ESG risk framework. Environmental risks are part of that framework, where we have a responsible investment policy. Our position at Lacers is to engage before divestment, and one of the things I didn't mention yesterday is that we do have a process for engagement. It's an 8-step process, and it's defined in our documents. Divestment comes at the very end. We like to take all measures to engage first, because we think that can be the most effective. The belief of the board is that engaging, being a shareholder, and being at the table to advocate for those changes is more valuable than divesting and walking away from it, and then we lose our voice. We also have the fiduciary responsibility, and I know maybe it's overused a lot, but to generate the best risk-adjusted returns. So with that taken into consideration, and knowing the fact that climate is a very important topic, one that cannot be ignored, we are going down that path at Lacers, but I would say that we're sort of in the early innings, if I can use the baseball analogy. We're at the very beginning parts of our journey of trying to understand how we can better incorporate climate change, environmental harm, things along those lines that are part of our ESG risk framework. Sure, there's more we can do, and I think our board would like to do more, but we also have very limited resources. At Lacers, we don't have a big staff yet, but I can tell you that one of my recent hires that I got approved in the budget last year was as a result of the ESG risk framework and our work going down this path. We still have a long ways to go, but we are going down that road. I'm hopefully a year, if I'm fortunate to come back, I can tell you a better story and the kind of progress that we've made.
Fernando?
I mean, I personally lived it this summer. Chicago had the highest, the poorest air quality index for a number of days because of the Canada fires. So I know it personally, and it's important to us. I'm challenged every time we have a meeting with our trustees because we have a very vocal base of constituents that want us to divest. But just as it's important to deploy money to do good, on the flip side, parking money doesn't do anything on the side. So I mentioned it yesterday, and I think and I'm already seeing it. I'm seeing managers coming in because of the IRA bill that President Biden pushed through. We are seeing solutions. They're coming to us already saying, you cannot believe what this thing has opened up, and let me show you some of the companies we're funding. And it's unbelievable. There's at least 20 examples that I've seen, and now we're starting to think about how do we deploy our dollars towards that so that eventually we move the needle and reverse what's going on this planet. So yeah, we're aware of it. And from an engagement standpoint this summer, we actually took back our right to vote by hiring Glass Lewis, and we are rewriting our proxy voting policy, not just on environment, but on freedom of representation, racial audit, or racial equity audit, all those things. There's a lot of factors that are going to impact how we vote our shares going forward.
Hamoto, I'm going to go through the local guys quite quickly, if you don't mind. Any thoughts on climate change? I feel like we have a bit of a global north, global south divide as we sit here.
Yeah, look, I had a couple of thoughts, but I had written them off. Look, I think... Eh?
Should I start? There you go.
You are from ESCOM. You're writing your own homework and marking yourself. It can't be. But I think for a entity like myself, we don't have those analysts to go look through what my asset service providers are buying. It is not a discussion that's top of my agenda. But it goes back to the discussion I mentioned earlier on. I need the big guys to start saying we are boycotting Sasol. We are not buying, we're not putting our money into Sasol. Collaboration and proxy voting. I need them to come say, here's the blueprint. These are the set of conditions we agree on. My 40 billion rand is nothing. But if I'm adding the 2 trillion, he's 170, and my 40 billion rand as a representative, I can change the needle on certain decisions and directions that companies take. So me, I don't have an internal department to look at what my 60 asset managers are doing internally to move the needle. But if we have these discussions before it becomes corrupt and collusion-driven, we can have better discussions. It's not top of the agenda, but I don't have any other platform to enforce climate change and tell government and ministers to stop worrying about just energy transition when we can't keep the lights on. Sorry.
Shouldn't you ask your consultants, Hamoto? Sorry, I'm just kidding.
Well, John said if you are smart, fire your consultant.
I don't think you must be afraid to be the pioneer, hey? Shafiq?
Yeah, Razia, in my opening remarks, I said one of the things is sustainability and the sustainable investment returns, right? To underpin that, we've already recently issued a sustainability policy that guides that decision making, and it's premised on 3 things: social justice, economic disparities, and climate change. And to crystallize that commitment, we are a signatory to the Net Asset Owner Alliance group as well. And where we are right now is baseline in the targets, but I don't think it's an easy discussion. Let's just disengage, divest, right, on boycott, cessation. No, I think we've got to be pragmatic, we've got to be realistic and responsible in this process. And I think it's important for us to grapple with these issues as well and understand the socioeconomic impacts of our decisions as we engage as well.
Thank you.
Yeah, look, briefly, we have the relevant policies that support responsible investment, the ESG frameworks, but engagement for us is the priority before you divest, especially because we're large and you understand the impact of divesting. I think Fernando mentioned, what will you do with the money if you divest and park it? So engagement is better. Have that dialogue and understand what you can do to change the behavior of these investee companies. Yeah.
Thanks, Musa. I think we've definitely run out of time, so thank you so much to all of the panelists. I think this was a very robust and informative discussion. As it turns out, being collaborative may be the solution to solving some of the global and local issues. Many hands, as they say, make light work. So thank you very much to everybody, and we do look forward to seeing some of these potential solutions coming to fruition.
Thank you. Round of applause. Thank you very much, Razia. The one takeout I have from that panel is that size matters. All right, guys, we're going to have to wrap it there. Thank you so much to the panel. I have powers vested in me as your host. In every environment, one must read the room and read the situation. And I can read that we might want to take half of our break for later now. I get the sense that a few of you may do with a bit of a leg stretch, some hydration, and then we'll take the 30 minutes we're going to have later. Perhaps let's take a 10-minute stretch for now, just to make sure that the next panel doesn't talk about size. We'll take a 10-minute stretch break, and please be back in the room. If you don't need one, you can just stay in the room. But for those that need some water, coffee, a 10-minute stretch break. Thank you.